action. What's price action? What it entails? Does it work in the markets? So if you're to realize, or if you are to check around the trading space, you will realize that price action traders use market movement through price trends to mold their trading edge or strategy. Now, what is price action? At Veritas, we say price action is a movement of an asset price over time, serving as a key indicator of market behavior. There's a couple of key concepts that you must look at, such as the first one is trends. So in price action trading, what a lot of price action traders do, they will first identify the trend. How do you identify the trend? In case of an uptrend, the market will be making higher highs. In case of a downtrend, the market will be making lower lows. The second thing to look at is support and resistance. Remember what we said about volume. What happens at your support level and your resistance level, whether you're in accumulation or distribution. The third thing is candlestick patterns, which can be your engulfing patterns, your dojis. Those are often used for entries. And then the last thing is chart formations. Those are your flags, your triangles, your head and shoulders. Those are some of the chart formations that we're talking about. Okay. Now, what you need to realize about price action analysis, it focuses on historical price movements to identify patterns or trends. Like we said before, in a downtrend, the market makes lower lows. In an uptrend, the market tends to make higher highs. So including these key patterns, is actually very, very important for your entries. But you can use patterns such as your head and shoulders, your double tops. Some price action traders even use trend lines, which help the traders to anticipate future price behavior. And the trends dictate overall market direction. Now, you can analyze price movement by looking at candlestick patterns, support and resistance levels, time frames, and their impact. What price action traders use, in most cases, is key formations, such as a doji, engulfing, hammers, and many more. In the case of support and resistance levels, at the support level, most traders will be looking at taking buy trades, meaning that there's a lot of buying pressure there. And then at the resistance level, most of them will be looking at taking sell trades, inducing sell pressure. It is vital to analyze these levels as a trader to identify entries and exit points. While we are still on the topic of time frames and their impact, this is a tendency of turning a lot of traders' lives into a non-stop and nightmare. Looking at the lower time frames, you will realize that they only indicate short-term trends, and the larger time frames, they are more reliable in terms of indicating long-term trades. Understanding these dynamics will help you as a trader to always see the reality of the trend across different periods. In simple terms, multiple time frame analysis helps filter short-term trend trades, which will filter out the noise, which will also make you take less trades. Have you ever heard of the saying, less is more? In trading, that's what usually works. What I usually do on my side, I will use the 4 hour for a trend or the daily. And then I'll go to the 1 hour to validate my pullbacks, volume pullbacks, to be specific. And I use the 15-minute or the 1 minute for entry into the trend with predefined risk on each and every trade. Now I think we can move on to market sentiment. Now let's talk market sentiment analysis or COT report data